I think it's caught the analyst community at large by surprise. I mean, the key thing, probably the most winding back, what was surprising, or what was the thing that caused so many people to get it wrong, was the fact that no one really saw OPEC throwing the towel in effectively and not cutting production at that 27th of November OPEC meeting back last year. And then since then, of course, we've just had incident after incident and event after event that is confirming prices to go lower. And certainly this year, young though it is, comments about the US exporting more of its ultra-light oil to help shale-producing companies in the US, according to the Obama administration, is bearish. Data, for example, on the level of production that we're seeing out of Iraq at record levels, I think the highest since 1980, out of Russia as well, extremely bearish, and certainly offsetting some of the concerns that people were zoning in on in Libya in terms of their lost production.
So basically what we're talking about, especially in the case of the independents, and Russia, of course, is the prime suspect. It's the number one in the independent camp. It's a bigger thy neighbor policy, right?
Yes, I mean it's
bigger thy other exporting neighbor policy.
In a way, yes.
Yeah.
It's quite it's certainly a very difficult forum at the moment, or arena, to try and predict where prices are going to go and where this bottom is going to be.
Okay, so here's the thing. I actually wanted to ask you that, right? Nobody really has an answer, but I mean, we had Tom Costello in that story just a couple of seconds ago, saying, we had one person quoted in that story saying that, look, Saudi Arabia is willing to see oil at 20 because they can well afford it, or afford it more than the U.S. rather.
Yes.
I mean, could it get that bad?
Well, if you look at things like the option profiles, the option market, that tend to provide enormous depth of color at times like this, especially as you get into price territory that's not sort of covered by normal technicals, as it were, and you look at who's doing what, there's an awful lot of open interest, puts being options that people buy to capture downside, at levels in Brent around $40 established very recently, even in TI down to, I think, $25. And generally speaking, if we look at how these option profiles have stacked up recently in the wake of this recent price fall, they've been quite accurate lead indicators of where prices are going to go. So certainly Saudi can deal with much lower oil than most of the other OPEC members, and they have, of course, very large reserves, I think in excess of $700 billion to weather through this storm, but it still hurts.
Okay, so let me ask you, a lot of people talk about this collapse in oil that we've seen over the last couple of months as economically beneficial and advantageous, because it amounts to basically a very nice, big, and in some cases welcome tax cut. As well, though, do you believe that the continuing collapse of oil can lead to further declines in yields?
In yields in terms of what?
Interest rates.
Well, it's a huge monetary stimulus process underway at the moment, and certainly people are now looking. Certainly us, we're looking at how this can help the eurozone recovery. What this is going to do in the US. So there's that side of the coin as well.